Hello, ACCA MOXIE students. My name is Neeraj Sen. I'm your ACCA trainer. I'm gonna start the dividend policy chapter. In this, we will understand how the company decide how much dividend we have to we have to distribute and how much we have to retain. So if this decision is not taken wisely, then it will badly impact the share price of the company. So it is really important that we have to understand what are the different policies and decide which one is the best. Okay, so let's start this one. So the relationship between dividend policy and financing decision. So what is the relationship between dividend policy and financing decision? So a dividend policy is how much money we have to pay and how much we should retain. So paying a bigger dividend has two impacts. So if your company is paying big dividends to the shareholders, which means that it can impact the financial condition of your organization. How it will impact? If the company will have less money left, which means that if you are paying higher dividend, you will have left less money. So if you have less money, then you will face capital rationing. What is capital rationing? Capital rationing is a situation where company decide that they don't have the full amount of for the investment in different and positive NPV projects. So if, for example, if they have the projects that require $10,000 but they have only the $8,000, so they decide that which one give the company the more income, or I can say more return. So the company will choose the best project out of them. So only invest $8,000 out of 10,000 projects. Okay, so this situation is called capital rationing. Otherwise, when the company have, they will invest the $10,000 because the positive NPV project means they have the earning potential and the company will be in good position if they enter into this project. Okay, so this is the background. So capital rationing and have to raise more finance, which means that if they have distributed the money, then they have to face capital rationing and raise the finance. Okay, the another holders, if the company is distributing more, if the shareholders will receive more income, which means that if the company is distributing the bigger dividend, which means that shareholder will get more income because shareholders will get the dividend and they have the mm, more income, so from their investment, because they provided the equity capital to the company, so they have the more capital. So if their investment is giving them the dividend, so which means that they are earning good return. So if they are earning the good return, so they will invest in the company further. Okay, this is the relationship. So let's do understand this theoretical consideration for dividend policy. So what are the dividend policies that can be your dividend policy as well? But I think this is not practical. This is only we can say that only only we can assume that, but actually it does not happen in the real life. That's why it is theoretical. So two main theories with regards to dividend decision. First one is the residual. Residual theory means the dividend are paid out of the out dividend are paid out only. So dividend is paid only after investing in the positive NPV projects. So if the for example, if you have the PBIT, if you have the 100 here, you paid 10 to the debt holders. Have the PBT 90, you paid tax 20%. 20%, how much? 90 into 20% and 18, 18, 18, 18. So you have the 72 that is available to shareholders for the distribution. If you distribute, but you can distribute this whole amount or you can retain this amount as well. But if you distribute, that will impact your share price, but we will look at this later. Okay, so that is available to shareholder, but what we will do that we will not distribute it. We will not distribute here in residual theory. We will invest this amount. If 72 is the positive NPV, we will invest this and we don't pay the dividend. But for example, if we have only opportunity to invest only 70, so dividend, how much we pay? We pay 2, that is the residual, because we don't have the opportunity to invest more, so we will pay the 2. But if we have the opportunity, then we will invest whole amount and we don't pay. That is called the residual. If we have the residual amount, that is the residual, then only we will pay. Okay, so whatever amount is left, that is paid to shareholders as a dividend. This can be seen, this would be seem to be consistent with the concept of trying to maximize shareholder wealth. Maximize shareholder wealth, but irregular dividend. Because we invested in positive NPV, which means that this will increase the shareholder wealth. How? Because the increase in because positive NPV will increase the profit, which will ultimately increase the shareholder wealth. This is the irrelevancy theory. American economist and stated that the pattern of dividend paid by the company is irrelevant. So it means that the pattern of dividend, you pay dividend or don't pay dividend in any year, it is irrelevant. Okay, because why? Because the company always invest in positive NPV, because a company should have to invest in positive NPV, because positive NPV means cash inflow minus cash outflow, which is at which is called NPV, and NPV is at the in present value terms. This is the present value terms. This cash flow is the in present value terms. So a company should always invest in positive NPV. Positive means the cash inflow is greater than outflow, so which means this is profitable project, so always invest in this. If the company cannot invest in certain projects out of its retained earning, if you have the retained earning here like this, you have the profit available to shareholders, this can go to retained earning, or you can distribute as dividend, or you can invest or distribute, whatever you like. Okay, so if you want to you can use that amount in retained from the retained earning and invest in this project. Okay, then it will need to raise funds from other sources, which M&M always believe out of its retained earning due. If a company cannot invest in certain projects out of its retained earning, then okay, so a company will always invest in retained in positive NPV, but a company cannot if a company cannot invest in NPV because the retained earning is distributed to shareholders, because you distributed as a distributed as dividend to shareholders, which means you cannot invest in the positive NPV projects. So what you can do, you can always raise funds from the other sources, because this is the positive NPV project, so you know that this is the profitable project, and everyone knows that this is a profitable project, then which means that it can easily get finance, the company can easily get finance from outside. Okay, really lead to existing shareholders receiving proportionately less of the return from the new project, but this loss less return from the new project. Why they are receiving the less return? Because out of the positive NPV, out of the positive NPV, if this is your 100 1000, sorry, if for example this is the 1000 is the net positive NPV, then you have to pay the interest that you borrowed. For example, you borrowed on 20%, so you will pay the 200 here. Okay, so you will only left 800 as a income from project. So which means that because you borrowed from outside and you have to pay the 20% as a interest on your borrowing, so you left only 800 as a income. So which means that the shareholders return to the shareholders are less because of this interest. So this will potentially lead to existing shareholders lead to less return, but this loss, but you made this loss or expense, because this loss will offset by the dividend you are receiving now, because you received the dividend here, you said you received the dividend here now. That's why the company borrowed from outside, so you received the dividend, that's why company borrowed outside. So ultimately you received the dividend, but you received the future income lower. So ultimately this offset your income. Okay, if the company do not pay dividend, then this income will increase, but because this reduced, that's why you received the dividend. So ultimately you received dividend, but you receive the lower income later. If you don't receive the dividend, then you receive the higher income later. So ultimately this means that you receive the same amount, or I think can say that. Okay, so hence the ultimate pattern of dividend payment is irrelevant, right? M&M stated that if a firm dividend policy was not the taste of the shareholders, if the shareholders don't like the dividend policy, then they can take action. How they take action? That dividend is lower than their desired. If the dividend is lower than their expectation or desire, then they sell the share. And get some extra income. Okay, so if their dividend is higher than they desire, then excess dividend to buy additional shares. So dividend is higher than the desired, so what they will do, they are happy with the company, they are happy with the company, they will try to invest the funds into the company again. Okay, but in reality, because this, when you sell the shares, when you sell the shares, have to pay the tax. Right? When you sell the shares, you have to pay the tax. So which will reduce your income, that income. Ultimately, this decision will not be taken by the shareholders in reality, because of the tax and the transaction cost that you pay to the broker for selling the shares. Okay, you pay to the broker for selling the shares. So ultimately, this is not relevant. Okay, dividend policies are that in practice there are other influences that need to be considered. Okay, so practical policies are shareholders expectation. So a dividend policy should depend upon the shareholders expectation. That is also called clientele effect. The directors propose the level of dividend. The directors propose the level of dividend. Shareholder either accept or receive nothing. Okay, so if they because why the directors propose, so having said this, the shareholders select the directors, because the shareholders appoint the directors. You know that shareholders appoint directors, and directors run the business, and directors can decide how much dividend they have to pay to the shareholders. So directors will generally try to fulfill the shareholders' expectation. So it is their duty that directors should try to fulfill the shareholders' expectation. But these expectations will significantly influenced by historic dividends. But the shareholders' expectation depends on historic dividends. Historic dividends depends on historic dividend. Why? Because historic dividend. Why? Because if the a company is always paying $20, 20%, or I can say 20% a dividend dividend of its income, then the shareholders expect that the if the company is paying 20%, 21%, or 24 sometime, then this expect that they are paying approximately 20%. So they always expect that the company should pay us the 20% as well. So this is their expectation because of historic dividends. Okay, so another example is, if your friend always get good marks in the ACCA exam, so what you can expect that in future he will get the good marks as well. So this is the expectations, because of history, or I can say historic dividend here. Okay, so companies attract dividends because of their historic dividends. So companies attract the shareholders. Also, one of the attractions that companies, those who pay higher dividends, which means that the shareholders prefer to invest in those companies. So historic dividends on the expectation that this pattern will continue, because they think that this pattern will continue in future as well. Okay, so shareholders may favor the existing policy due to tax preference or income, or they need the cash flow. That's why they prefer this historic dividend policy. Okay, also known as clientele effect. If a company changes the dividend policy, if the company changes the dividend policy, the existing shareholders may seek to sell. If the company don't pay the 20% as a dividend, if company don't pay the 20%, if we pay lower dividend or don't pay the dividend and invest, then what the shareholders do, they will sell their investment. So they sell their investment, which means that the increase in supply of shares in share market, supply of shares in share market will increase. So this increase in supply will lower down the share price will fall. So, and they reinvest in companies whose dividend policies meet their needs. So they will sell their investment in shares in this company and invest in different companies that pay dividends around, uh, which is they are expecting 12%. So similar to that. Okay. Next is the signaling effect. Signaling effect is investors do not have perfect information and capital market at its best, because investors always don't have the perfect information. But because investors don't have perfect information, but capital market means share market or stock market, but share market and stock market prices are at its best. So so when the investors know that the dividend will be announced in the future, so this price will increase. Prices of shares will increase, because they know that in the future the the dividend will be announced and they will get the dividend. That's why the share price will increase. Okay, so this is called the reaction or signal effect. You can say that shareholders react to the positive and negative news. Okay, so which means that anyone who have not buy the shares of that company, then they will try to buy the shares and get the dividend. Okay, so causing share price movement. If the company cut the dividend, which means that if the company cut the dividend, which means if the company don't give dividend, this is a sign of bad news, which means they sell the shares, leading to reduction in share price. We already mm, already understand this. Okay, but if this is a good news, which means that say dividend, they will distribute the dividend, which means that increase in dividend is a sign of improved future. Or I can say that company has the cash flow to pay the dividend, so which means that it is a good company, has the good cash flow position and the future as well. So the share price will increase, and shareholders will try to buy the shares to get the dividend. Next is the legal constraints. When we pay the dividend, there are some legal constraints that we have to keep in mind, that like carpents, that legally a dividend can only be paid out of accumulated profit. What is accumulated profit? That is retained earning. So a dividend can only be paid out of retained earning or profit. So for example, if you have the profit available to shareholders, that is 7200 here, we have the 7200 here, so you can distribute this 7200 whole amount as a dividend to the shareholders. But if, for example, we have the profit available to distribute to shareholders, that is 72. Okay, but if you want to pay the dividend, you want to pay dividend 80. So what you can do, that you can pay rest of the 8 from the retained earning. Okay, so this make the dividend as 80. So if you have the retained earning like 10, so after the dividend you have the 10 left, in 2 left in the financial statement as of the. Okay, so you, which means that you can only pay dividend out of the profit available, or if there is any profit that is retained from previous years profit, that is paid here. So if you want to pay dividend, you cannot pay by borrowing from outside. You cannot pay dividend by borrowing. You cannot borrow. You cannot, if you want to borrow money from outside bank or something and wants to pay this amount it as a dividend, so this is not allowed as per legal law. Okay, liquidity, a dividend is optional cash outflow, which means that dividend is not required to be paid compulsory. So if the company have the profit, then he can pay. If the company don't have the available profit to distribute the shareholders, then he cannot pay, then no need to pay. Okay, so it's a optional cash flow. Also, the directors can decide whether they want to pay the dividend or not. If they don't want to pay the dividend and retain this profit as a retained earning, then they can transfer this as a retained earning or invest in any other project as well. So this reduces the liquidity. Dividend is an optional cash outflow, which is by definition reduces the liquidity of the company. Okay, thus a dividend should only be paid if company left with the excess of sufficient cash. If the company has sufficient cash or profit retained earning, then they can pay. Okay. Next is the alternative to cash dividend. So if a company don't want to pay the dividend, then he can pay if a company is struggling with the cash. So alternative to cash, he can pay the dividend in any other form other than cash. So other than cash, as a dividend is proposed by the directors, so view as a being the most knowledgeable person about the company present future. Directors are the most knowledgeable person about company future present. So dividend sends as a signal to the market that will influence the share price. You know that when the company pay the dividend pay, then which means that it is a good company, then share price will increase. If the company don't pay the dividend, then share price will decrease. You know this. Okay, so which means that if a company does not want to pay cash dividend, or if the company don't have the cash to pay the dividend, so it can pay the dividend in other forms like scrip dividend. A scrip dividend is paid by issue of additional company shares, which means that instead of paying the dividend, you can pay the dividend. I will pay you dividend, but not in money. I will pay you shares. Dividend, I will pay you shares as a dividend, okay, rather than cash. So it is offered based on the pro data basis. So if you have the 5 shares, you can get one shares additional as a dividend. Okay, this is defined as a pro rata basis. From a company point of view, this has the advantage of preserving the cash position, because the company don't want to dilute don't want to don't want to pay the cash. So this means that their cash position will remain same. Okay, so they will remain the same cash position. substantial number of shareholders will take up the offer and decrease the company gearing, which means that if increase in shares when increase in share capital means decrease in gearing. Gearing is debt divided by equity. So if which means that this one is increasing, so this will remain same, so it means that this gearing will decrease. Okay, so getting profit and may therefore enhance the borrowing capacity, which means that if the equity increased, which means that debt is lower than the equity, so their gearing ratio will decrease. So this means that company have less less borrowing from the banks or any other institutions. If the company have less borrowings, which means that company can take the borrowings from the company, because they have the ability to pay back the borrowings, because right now they have less borrowing. Okay, there are also disadvantages of a scrip dividend, assuming that dividend per share is maintained or increased. There are also disadvantages of scrip dividend. What are the disadvantages? That assuming that dividend per share is maintained or increased, the total cash paid as dividend will increase in future. Total cash paid in dividend will increase in future. Scrip dividend may also seen as a negative signal. So if you are not paying the dividend in cash forms and in the form of cash, sorry, in if you are not paying dividend in cash in money form, but you are paying dividends in shares, which means that the shareholders will assume that company don't have the sufficient cash. If some company don't have the sufficient cash, which means that company is struggling with cash and they have the cash flow issues, which means that company has cash flow issues, and they will might be some shareholders will try to sell their investment. Okay, next is the alternative to cash dividend. They can additional shares to the shareholders. Next is the share repurchase. Next, if you want dividend, then you company can give the shareholders an option to repurchase their shares. Instead of paying the dividend, I will purchase your purchase shares dividend as a purchase of shares, because you want the income, or you want the money for your expenses. So what I can do as a company, I can purchase your shares, some amount of your shares, so you can get the the money as a dividend. Okay, this can be used as the change the capital structure of the company, which means that if the company is purchasing the shares, which means that structure of the company will change, capital structure, because the owners of the company will be less, right? Owners of the company will be less than it was before. Okay, so another form like shareholder concession, another form is the concession. Shareholders are given concessions. So if shares of a railway company, then some companies, that what they do, they provide the services to the shareholders at a discounted fare, which means ultimately you some save some fare whenever whenever you whenever you travel, you save some save some fare or money, which means ultimately you get the money in your wallet, right? So this is another form of dividend. I hope you understand all these meanings of the policies. What are the different policies alternative to dividend? What are different kinds of alternatives we have available for the shareholders? So it is very easy to understand. Just you need to watch this again if you have any confusion. Hey everybody, my name is Neeraj and thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.